When we compare Denmark's tax system to those of other European countries, it is important to move beyond the stereotype of high taxes and look at the design, the underlying philosophy, and the outcomes it enables. Denmark is widely known for its relatively high overall tax burden, with total tax revenue typically around 45 to 47% of GDP, placing it among the highest in the European Union. However, what truly differentiates Denmark is not just the level of taxation, but the combination of simplicity in certain areas, the strong link between taxes and welfare services, and the predictability that businesses and individuals can plan around. At the core of the Danish system is personal income taxation, which is progressive and composed of several layers. A flat municipal tax that varies slightly across municipalities, a national tax component, and labor market and social security contributions. The top marginal tax rate on personal income is among the highest in Europe, exceeding 50% when all components are included, which is higher than in countries like Germany, the Netherlands, or the United Kingdom, and closer to the upper range seen in Sweden and Finland. Unlike some European peers, Denmark has relatively modest social security contributions for employees and employers, with most welfare spending financed directly through general taxation rather than earmarked payroll taxes. This differs significantly from systems such as Germany's or France's, where social insurance contributions form a substantial part of the tax wedge on labor and are often more fragmented across health, pension, unemployment, and other funds. Another critical pillar of the Danish model is its broad-based consumption tax. Denmark applies one of the highest standard VAT rates in the EU, at 25%, with very few reduced rates or exemptions compared to countries such as Spain, Italy, or Ireland, which apply multiple lower rates for items like food, tourism, or cultural services. This broad VAT base helps generate predictable revenue and supports the financing of extensive public services, while also simplifying administration relative to systems with complex lists of reduced-rate goods. In corporate taxation, however, Denmark is not an outlier on the high side. Its corporate income tax rate is in the low to mid-20s, comparable to or slightly below the EU average, and similar to countries such as the Netherlands or Austria. This contrasts with the perception that a high-tax country must necessarily have punitive corporate tax rates. In fact, Denmark has made efforts over time to reduce the statutory corporate rate and to maintain an investment-friendly environment, especially around transparency, stable regulation, and efficient dispute resolution, rather than competing through aggressive tax incentives or very low rates, as seen in countries like Ireland or some smaller EU jurisdictions. One of the distinguishing features of Denmark's approach is the emphasis on transparency and compliance. The tax authority, SCAT, operates in an environment of relatively high trust, and much of the system is digitalized and pre-filled, reducing the administrative burden on individuals and companies. When compared to several southern and eastern European countries, where tax administration can be more fragmented and informal economies larger, Denmark's capacity to collect taxes efficiently stands out. This has a direct impact on how high nominal tax rates translate into actual revenue and service levels. The Danish system is also tightly linked to a comprehensive welfare model. High personal and consumption taxes finance universal healthcare, tuition-free higher education, extensive parental leave, and relatively generous unemployment and social support schemes. In many other European countries, benefits are either more contribution-based, tied to specific insurance funds, or less generous relative to wages. For example, while Germany or France also provide strong welfare states, they rely more heavily on employer and employee contributions, and the connection between what one pays and what one receives can be more explicit. In Denmark, the logic is more collective. High taxes are justified by universal access and relatively low out-of-pocket costs for key public services. From a competitiveness perspective, this design prompts a nuanced assessment. On one hand, high marginal tax rates on labor can be a challenge in attracting and retaining certain high-earning professionals, especially when compared with lower tax hubs such as Switzerland, Ireland, or some Central and Eastern European countries. On the other hand, Denmark scores consistently high on measures such as ease of doing business, infrastructure quality, education levels, and overall institutional trust, all of which are underpinned by the revenue generated through its tax system. For businesses operating in Denmark, the predictability of policy and the quality of the workforce often offset concerns about personal tax levels for staff. When we benchmark Denmark against its Nordic peers, we see clear similarities but also important differences. Sweden and Finland also combine high tax-to-GDP ratios with extensive welfare, but they generally apply somewhat lower VAT rates with more reduced categories, and they have different balancing points between income, payroll, and property taxes. Norway, benefiting from oil revenues, can finance part of its welfare model without relying as heavily on general taxation. Denmark's model is therefore notable for funding a large welfare state almost entirely through broad and visible taxes on income and consumption, supported by a high level of citizen trust that these funds are managed effectively. Relative to Western and Southern European countries, Denmark's property taxes are not particularly high in international terms, and wealth taxes per se have mostly been abolished, in contrast to certain debates ongoing in Spain or proposals in other countries. Instead, Denmark leans more on recurring housing value taxes and registration duties, though these have been politically sensitive and subject to reform. Looking ahead, the Danish system faces many of the same pressures as other European countries: an aging population, the need to remain attractive to skilled talent, and increasing demands on healthcare and green transition investments. Policy discussions often center on whether it is possible to slightly reduce marginal tax rates on labor, particularly for middle-income workers, while broadening the base further or shifting more toward environmental taxation. In that context, Denmark's experience offers a reference point for European policymakers. It shows that it is possible to maintain high levels of taxation and still foster a dynamic, innovative economy, provided the system is perceived as fair, efficient, and strongly connected to tangible public value. For individuals and firms considering Denmark in comparison to other European countries, the key takeaway is that the country exchanges higher visible tax payments for a lower level of private spending on healthcare, education, and social insurance, as well as for a high degree of institutional stability. Evaluating its attractiveness, therefore, requires looking not only at tax rates in isolation, but at the total package of costs, risks, and benefits associated with living and working in a highly coordinated, high-trust and high-service environment.